Thank you for joining us. My name is Mark Reichman, and I'm a Senior Research Analyst with Noble Capital Markets. We're pleased to welcome Stuart Bowden, President and Chief Executive Officer, and Melissa Kugel, Chief Financial Officer of Ranger Energy Services, Inc. Ranger is one of the largest providers of high-specification mobile rigs, well services, cased hole wireline services, and ancillary services in the U.S. oil and gas industry. The company's shares trade on the NYSE under the ticker RNGR. Welcome, Stuart and Melissa.
Thanks, Mark, and thanks everybody for joining today. We'll talk for about 15 minutes, and then we'll open up for a little Q&A at the end. As Mark said, I'm Stuart Bowden, President and CEO of Ranger.
And I'm Melissa Kugel, Ranger's CFO.
All right, let's dive in. As Mark said, Ranger is traded on the New York Stock Exchange. Our ticker is RNGR. We are one of the largest well service providers onshore U.S. If you see in the map, those stars represent locations where we are. We're in Eagle Ford, Permian Basin, kind of North Texas, Mid-Con, DJ, Powder River, and the Bakken. We're not in California or in the Northeast, but really kind of right up the central western part in the core basins of the U.S. Things as we go through the next little bit of time together, we would like to focus on are one, that we're very production focused. So a lot of other companies are either exposed to the drilling part of the investment cycle or completions. We have a little bit of completions exposure, but a lot more is on the production side of things, which is a lot more OpEx exposure with our customers, which means we think we're a lot more resilient through the cycle. You'll hear us talk about that a lot. I also like to emphasize that we convert a lot of our EBITDA to free cash flow, so I have very high cash flow conversion, and we're very capital returns friendly, and we've got a great balance sheet with zero net debt. To help you scale the size of the business, obviously these will get updated here shortly as we close out the year, but in 2023, a little over $600 million of revenue, about half of that in high specification rigs. Again, these are well service rigs. A little less than a third in wireline and 20% in ancillary. And in 2023, we had almost $84.5 million of EBITDA and about 64% conversion into free cash flow. So that resulted in $54.4 million in free cash flow. And again, these are some themes that we'll talk a lot about as we go forward. To talk first of all about just being production focused, across the top of this page, you can see the value chain for oil and gas. So the first step in drilling a new well is drilling the well. So these would be, again, drilling companies. This is not something that Ranger does. The next stage is completion. This is where fracking happens. So this is where the well is prepared to actually move it into production. Then you go into production, then finally into the plugging and abandonment or the remediation of the well. Drilling and completion tend to be CapEx items for our customers. And even though they're very CapEx intensive and expensive, if you will, the duration is quite short. If you move into production, a well could be online for 15 to 20 years. And if you think about going back into wells and maintaining those wells, that's really what the core of our bread and butter is. So after a well has been drilled and completed, usually in the first 6 to 9 months, you need to go back into that well and put it on artificial lift, because typically the pressure isn't high enough for that well to produce on its own. So we need to put in some kind of a pump. That could be an electric submersible pump. That could be a rod pump. It could be a gas lift system where you inject gas back into the well and to help with the flow. But again, you typically need a well service rig to install a lot of that equipment, and that's where a company like Ranger would come in. And then over time, you need to go. Could be remedial work. We're doing simple cleanouts. Maybe we're replacing tubing or a more complete workover of that well. And you're typically going back into a well every year or two, depending on the formation and the fluids in that well. So again, a lot more of our exposure is tied to production, almost 75%, and then the balance would be on completion. And then we'll talk a little bit about on decommissioning. Less than 10% of our business, but that's, if you've heard about the orphan well program or plugging and abandonment, we think this is a real high growth opportunity for the company. To put some numbers around that and hopefully give you some data to play with, if you look at the yellow line, we've indexed spend for production, completions, and exploration back to 2010. And you can see on the production side, so there is volatility, but certainly not as much as you would see on either exploration and drilling or on the completion side. And through this time period, you actually saw spending on well production increase 59%. Completions increased 21%, and exploration and drilling has actually declined over time. And a lot of that is just driven by the more intense completions that we're seeing. And on the production side, we would tell you that as long as the industry is drilling more wells than are being plugged and abandoned, our addressable market is naturally growing. And so it's not surprising to see that spending over time on production increases. Give you a little bit more color on the segments that we operate in. So our real bread and butter is the high specification rig business. These are mobile rigs, as we said earlier. So we go from well to well. We drive them from pad to pad to go work on existing wells. It's our anchor business. We're one of the largest providers in the market. We do have some excess capacity that's really driven by our M&A strategy and a lot of the acquisitions that we've done over time. But what you'll find is we're a very disciplined management team about when we take those assets and put them into market. They aren't free deployments. Some of those do need some maintenance CapEx on them. But we highlight that because if the market were to really grow, and one of the catalysts we think could be the natural gas markets over the next couple of years for us, we would have the capacity to actually put additional equipment into the market. On the wireline side, a lot of this business is really tied to the northern regions, the Bakken and the Powder River in particular, although we're growing the DJ and our business in the Permian. This is a market that on the completion side has been pretty challenged, but we've been really growing it very consciously and sort of methodically over the last 18 to 24 months. And if you think about wireline, again, a lot of this can be intervention related. It's a little simplistic, but think about a really long extension cord. So if you ever need to convey electricity into a well to do some work, you would need wireline. And one of the things we also offer with wireline is pumping, because easy to get the wireline down in the vertical section of a well, but you need to pump the wireline and the tools into the horizontal section. And then finally, in our ancillary services segment, there's a couple of different service lines in that. So one is our rental and fishing business. We also have a coiled tubing business. That's something that we picked up that really got a great deal on as part of our basic asset acquisition in 2021. But the two things I'd like to highlight are plugging and abandonment and Torrent. Plugging and abandonment, as I mentioned earlier, is a segment that we see is growing. We're seeing regulators becoming increasingly, aggressive, demanding that wells get plugged, particularly in some jurisdictions before they issue new wells. So that this is something that's been growing. And then Torrent is a service line that's really dedicated to cleaning up gas streams and supporting infield power. So if you have a gas stream and you're not able to get that gas in a pipeline or through a processing facility, we in essence offer infield gas processing. You're able to knock out the liquids. The liquids can be sold into the market. And then you have a cleaner gas stream that could be used for power, could be used for artificial lift. And that power could be to power a field. It could be to go back into the grid. It could go for crypto even. So we see kind of all of that. If you kind of think about our business, and I'll turn it over to Melissa here pretty shortly, but one of the things we wanted to highlight is capital returns and growth of the business. And you can see an average return on invested capital of 9%. In the top graph, I'd kind of point you to the top right. So this is Q3 of 2024, where you can see over the trailing 12 months at the end of Q3, our free cash flow is $52.2 million, and we returned approximately 59% of that through dividends and share repurchases back to our shareholders. So as I said earlier, I think one of the things we want to leave you with is that we're very shareholder friendly, but we also generate quite a bit of cash. Across the middle, as you can see, our cash flow conversion through time. And again, I think one of the things we're very proud of is that a lot of our EBITDA does in fact convert to a cash. We tend to see a pretty big sort of increase in conversion in Q4, and part of that is because we have some seasonality, and we tend to have a bit of a working capital unwind that happens in Q4. And then finally, along the bottom, as you can just see the growth in our revenue, the big growth in 21 to 22, a lot of that was on the back of M&A, but it was also on just a growing market. But one of the things I think you'll see in 22, 23, and when we release the end of year for 24, is just the consistency of the business because of its production focused. To talk a little bit about why we think we're a lot more resilient. So if you look at this graph and you can see in the middle graph, and you can see the line that's trending down, that's land rig count. These are not well service rigs, these are drilling rigs. So again, these are rigs that are making new or creating drilling new wells. And it's been a pretty rough market, right? So you can see that rig count has declined over that time period. However, for us, you can see that our revenue has consistently grown through that time period, particularly in our high specifications rig business. And that just goes to the resiliency of the cycle. We've also really been, I think, very fortunate. Consolidation in the E&P space has helped us. We think we've gained share as a result of that, and that's contributed. But I think it does give you a sense of just how resilient this business can be, despite some activity declines on the drilling rig side. And then on the right side, you can just see our EBITDA and our margins through time. And I think we really feel like Q2 and Q3 start to just show what the business can really perform, particularly with our biggest customers that are demanding not just rigs, but a lot of additional equipment to come with the rigs as well. And the last slide before I turn it over to Melissa to finish off is just if you look at our blended rig rate through time. So we get the question a lot, well, have you been able to hold price? What's been happening? You can see that we've actually been increasing our blended rate through time. Our core rig rate has truthfully been pretty consistent. But what we're finding with our biggest customers is that they want more complete packages. They want pumps, they want power swivels, they want pipe handlers, other things attached to that service offering. And those tend to have really nice pull-through for us. And that's what's being reflected in the increase in the blended rate as well. And the last thing I would highlight is if you look at the right, we really do, our core bread and butter is with the largest super majors. We tend to be the largest well service provider for, as an example, Exxon, Occidental, ConocoPhillips, Chevron. And really that's what differentiates us is our commitment to safety, our training programs with our people, and our scale across the basins. But we really pride ourselves on having equipment that is properly maintained, that is being certified, and again, having world-class crews.
Maybe I'll spend one more second on this slide, actually, just to reinforce E&P consolidation. So one of the things we get asked a lot by investors about is, okay, so all of these deals are getting done by the super majors. They're your biggest customers. Is your share of the pie shrinking? Because 2 + 2 doesn't equal 4 in the new world, it equals 3. And what we have found that's been somewhat unique and a bit of a buck the trend for Ranger is, although that's true, we would cite back to that's more something that you're seeing in drilling and in completions area. And when you go into the production area, what we're finding is as these acquisitions are taking place and these companies are starting to integrate, they're shrinking vendor list, as Stuart mentioned. And as they're shrinking vendor list, Ranger has largely been working for the bigger providers, which have been the ones driving the consolidation. And so we've tended to benefit from the company getting acquired might have had a longer vendor list, might have had vendors that were more regionalized. And what they're trying to do is create a lower 48 agreement. And when you're creating a lower 48 agreement, there's only 3 or 4 of us that you can make that agreement with. And so Ranger's really seen, when you look at the trajectory and high spec rigs that Stuart showed you a moment ago, we've seen a benefit really on the backside of this consolidation, not because they're doing more work, but because we've probably gained market share through that exercise. So with that, one of the things we wanted to show you was really just a view of sort of annual revenues and our EBITDA. And we've talked about it before, but it's worth revisiting probably a couple of times, because it would be true to say very frequently Ranger is sort of lumped into the bucket with drillers or frackers, particularly because we're work rigs, right? And so we bring this up to say, if you look at the way that the past few years have transpired, and you look at the 779 peak in rig count down to 622 in 2023, and down to where is now about 575, we have been resilient through that process. So where virtually all of our peer group that we would be in an industry sector classification with has seen meaningful declines. In fact, if you look at Ranger, our 2024 performance will be pretty comparable. What you'll see is, in fact, all service lines that we sort of walked through earlier are growing year over year, with save one that has that completions exposure. So that was a meaningful pullback in one service line, but across all other service lines, Ranger has actually managed to grow 22 to 23 and 23 to 24 as well. So, we'd like to spend a little bit of time on our acquisition slide, and I've long since called this Stuart's favorite slide. Ranger has a track record of actually being able to take decisive and prudent action whenever opportunities have presented themselves. We did a series of acquisitions in 2021 and made an investment of about $74 million. And that proved to pay itself back off over the following 6 quarters. And that was really something that sort of changed Ranger. We would tell you the face of Ranger forever. It by some measures doubled, by some measures tripled the size of the company. And we think what it's done where we stand today is it's proven we have a track record of making good deals. We make prudent allocation decisions. We manage the balance sheet very vigorously because we like to be able to take advantage of opportunities when they present themselves. We get the question at times, do you intend to carry a cash-free balance or a debt-free balance sheet forever? And what we say is no, our balance sheet is frankly our best asset, because if we saw an opportunity present itself, we could actually seize it quite readily. So with that, I want to kind of start to close out with our capital returns program, which we actually hold up as the best that you'll find. We have made really prudent return decisions, very aggressive, really frankly, on the capital returns front, from the perspective of a small cap oilfield services company. We would argue you probably can't go find another small cap oilfield services company that has been able to touch the framework that we've rolled out. And we rolled it out last year as we created the debt-free balance sheet. And we said, look, we believe very strongly in the cash flow potential of this company, and we're going to put our money where our proverbial mouth is. And so we instituted a dividend. And we have a base load dividend. And we also said, look, we believe our shares are meaningfully undervalued in the market. And we undertook a very, very aggressive repurchase program. And you can see where we've returned over 80% of capital. We've bought back approximately $35 million worth of our own shares, approximately 15% of the company. I have very much enjoyed with recent trading, sharing with the investor community, the shares we purchased, that $35 million, we bought it back on average at $10.35 per share. So we would tell you we did absolutely the right thing by our shareholders to date, and we will continue to do so in the future. I'll close out on just sort of highlights and key takeaways. We always go right back to our free cash flow conversion rate, and we're very proud of it, and we think that's a real differentiator. We are capital intensive, but after the initial capital investment, our assets don't tend to break down, which allows for a lot of free cash flow generation potential over the life of the asset. We think we are exposed to a lot less volatility than the next peer due to that production focus that we talked about earlier. We think we have asset capacity. So when the gas markets turn around, it depends on who you ask, whether they believe that's happening this year or next year. But I think there is a view that eventually they will. And as they do, we are very well positioned to continue to deploy additional assets without having to spend a lot of capital to do so. We have an aggressive sort of campaign to return capital and to prove to the market we're strong capital allocators. And I think we still think that there are plenty of accretive transactions out there to do. We are the best balance sheet in the small cap space. And when we look at the peer group that's largely private, we can be a great vehicle for those to monetize and create very great value on behalf of that group as well as our own shareholders. So with that, I'll stop and we'll turn it back over to Mark for questions.
Thank you, Stuart, and thank you, Melissa. So based on your macro level outlook for oil and gas, How is the company positioned for 2025? And do you see any key themes emerging?
Yeah, I'll start, and I'm sure Melissa will chime in as well. When we talk to our customers, Mark, I think kind of universally what we hear is steady as she goes into 2025, right? So we're not hearing with our biggest customers really a lot of talk of a pullback, or truthfully of adding really a whole lot more, with one exception, right? So we talked a lot about consolidation and that's been happening on the E&P side. A lot of our customers are still integrating some of the companies that they purchased, and we do think there will be some modest incremental demand from us putting rigs to work on those in those assets once they complete the integration. So what we're planning is kind of modest growth year over year. The second thing I would say, a trend, and it's more of a question or a potential catalyst that we're watching, are the natural gas markets. We're not necessarily planning for a lot, and certainly in the first half of this year. I think we're kind of watching closely in the second half of 2025. But that is something where if the natural gas markets kind of moved in a meaningful way, even though most of our exposure, just where our footprint is in the oil basins or oil dominated basins, we do think that that will just tighten the whole market up. So I think that's something that we're looking at.
Yeah, and I would only add maybe on that front, I do think there is a view that at some point the gas markets are going to turn. And so I think, to Stuart's point on a catalyst front, we get that question a lot. Yeah. And I think we're focused on being ready. It's not a hope as a strategy. Our numbers are published do not include that. That said, we are making sure, and we are keeping eyes peeled and ears to the ground for, as that starts to shift, we are able to be there and be ready to seize upon that opportunity, whether it's in 25 or 26, or even if you're a real bear, 27.
And you're referring to natural gas fired power generation, to satisfy electrification, this build out of data centers and things like that.
That's certainly part of it, Mark. I think the other thing is LNG exports, right? So if you do see kind of meaningful, or just as the LNG export market is kind of more developed, and there's a lot of projects under construction right now, as that starts to, as you need to fill those plants, that's the other catalyst. But you're right. The other thing we hear a lot about is just the need for gas-fired power to satisfy data centers.
I wanted to touch on the company's capital allocation strategy. You've been returning a lot of capital to shareholders. How might your strategy change over time when you're thinking about return of capital versus funding growth?
Either way.
I'll start. When we've done it, we always felt like we had, just given our great cash flow conversion, that we could make sure that we kept the balance sheet clean, which provided optionality for growth, that we could pay a dividend and also buy share repurchases. I think how we sort of kind of ramp each of those up and down depends on what we're seeing in the market. Depends if we feel like that there's a M&A opportunity. Melissa alluded to, when our stock was trading near 10, it was really easy to say, look, we think our own shares are probably the best investment we have, and we put a lot of money actually back into repurchasing shares. I think we're probably entering a period right now that feels a little more balanced between some of that. Our stock price, we're trading kind of mid-15s right now versus closer to 10 earlier back in 24. The M&A markets, I wouldn't say that have broken free. We still see a bid ask, but we're cautiously optimistic that we might be getting closer. So I think we want to make sure that we're poised to take advantage of that when it comes.
Yeah, the only thing I would add there is we have made a commitment to return 25% of our free cash flow annually. So what you would see is a potential rebalancing where, to Stuart's point, every dollar has gone to share repurchases because it was too compelling to make an argument that we could go do a deal on better terms. But I think what we're seeing this year is you may just see a more balance. Now, that may change next month. We do keep, the other thing I would say is, although we made a commitment for a minimum of 25%, there was a reason why we said minimum. And you saw every reason for us to do a much more aggressive approach. But it is very much something that we look at very, very frequently. So every quarter we go back to the board, we do our own DCF, we do our own analysis of where we're at. We still think we are at a very compelling valuation. It's just not quite as compelling as it was at $10. And so it's a very fluid, I would
Yeah.
guess, and we try to make a prudent choice sort of every quarter we're looking at it again.
And then just lastly, what does your share structure look like in terms of ownership by management, institutional investors, and retail investors?
Yeah, well,
Yeah, sure.
I'll start. So on the management side, I mean, pretty typical for a public company. I think collectively we all kind of, own low single digit percentages, but the management team is very much incentivized by the long-term performance of the company through performance stock units and restricted stock units. On the insider side, there are two major insiders right now. And these are kind of legacy back when the company went public. It's kind of called Bayou Wealth, or it's an investment vehicle called Bayou Wealth Services, which was one of the companies that got brought in with Ranger, and then CSL Capital. I think collectively they're probably down to 25% plus or minus at the current time. And then the balance, you probably can talk better than I can about the balance between retail and institutional after that.
Yeah, we don't have great insight. We don't actually have a lot of tightly held institutionals. So I would tell you the balance of that 75%, well over 50 is largely in sort of retail as best we know today. We had a fair amount of trading activity, is largely between retails and smaller chunks in institutions. But we did have up through early, or I would say mid 2024, we had a very large institutional holder in T. Rowe Price. They've since monetized their asset. They backed the company from IPO through our basic acquisitions in the 2021 period. But they have decided to move in a different direction, and they monetized and got a great return. So the rest of the institutions hold relatively small positions. So our institutional holders are not significant in the book, or they are numerous. The only other thing probably worth mentioning is, so your management team, everything Stuart said, but both he and I have actually, whenever we were at really compelling, we've actually both bought into the company as well over the past year and a bit.
Yeah.
Well, and to follow up on my capital allocation strategy, where would you consider investing your growth capital at the present time?
Yeah, a couple of things I would sort of highlight, Mark, is one and this is probably more on the growth CapEx side. So we have demand from our customers. I mentioned it earlier, not just, they want just not a rig, but they also want all the ancillary equipment. And we were fortunate that we bought a lot of that equipment back in 21 as part of our acquisitions, but a lot of that's been deployed. So if you kind of noticed in 24, a lot of our growth CapEx, and it ran a little higher than it had in the past, was dedicated to that, was really on the back of customer demand. That's one thing. I think if like on the M&A side, we're big believers in consolidation. We think there's more to do. We think there's another at least big deal to be done on the wealth services side. So we are looking in that space. We're looking at some of the other service lines as well. We're looking at some differentiated technology that could potentially apply to our plugging and abandonment space. Our torrent business is likely to, in the back half of this year, be fully deployed with its assets. So we're starting to have pretty open conversations about, is there an M&A strategy there, or is there a growth CapEx there? So I think those are some of the places we're really looking at.
Well, this has been a very informative and compelling presentation, and thank you so much for joining us, Stuart and Melissa.
Thank you as well.
Yeah, thank you, Mark. Really appreciate it.
With more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then ChannelCheck truly is your tree. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series lunches, and to be part of the preeminent annual Small and Microcap Investor Conference, NobleCon. And here's the best news. Since ChannelCheck is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why ChannelCheck is North America's leading source of research on the companies that just may change the world.